Global reinsurers met their cost of capital for a third straight year, even as the market softened. Here to talk about reinsurance in the region as part of AM Best's overall look at the global reinsurance industry ahead of the Rendezvous des Septembre in Monte Carlo is Helen Andersen, industry research analyst at AM Best. And Helen, what are the main market conditions that are making these year after year returns possible?
So one contributing factor is there are few market entrants. We haven't really seen a new class of reinsurers entering the market to add competitive pressure. So while we do see some changes to broaden policy wording or narrowing exclusions in response to competition, reinsurers haven't had to make any more substantial structural changes to their program in response to competition that would have a bigger impact on returns. And another thing is they've also benefited from high interest rates, and they still do, even as they begin to come down, as some central banks are starting sort of an easing cycle. As older, lower yield bonds mature, they reinvest those proceeds into current higher yield bonds, which sets them up to earn relatively higher investment income for, a couple more years, even as headline rates go down.
At the same time, catastrophe losses continue to be high. How have reinsurers cushioned themselves against these losses?
Cat losses have been very high. They've been over $100 billion in US dollars in just insured losses for the past several years. But crucially, a really significant portion of them are coming from secondary perils. In 2025, over $50 billion US dollars was from severe convective storms. And with these smaller and more medium-sized events, reinsurers have raised attachment points on their policies. So most of the impact from these events is being retained by the primary insurer, which insulates the reinsurers then from those losses.
How did the median return on equity compare with the cost of equity, and what does that tell you?
So overall, reinsurers' returns on equity were much higher than the cost of equity. And what that means on a basic level is that reinsurers' returns are high enough to offset the risk that investors make when they buy shares in that company, invest in that company. And what this means is it's a good sign for their ability to continue to attract investment if they're making these high returns and investors are getting the return on their investments. And it's a sign that they have been able to maintain profitability even in the face of these challenges like high catastrophe losses and softening rates.
Reinsurance rates have softened. So Helen, what are you expecting for these return measures going forward?
So undeniably, the high jumps in rates in 2023, they went up nearly 30%, have contributed to these really high exceptional returns that we've seen over the past 3 years. But in 2025, even as rates went down, they still stayed high, though, of course, cat losses in 2025 were also below expectations. Still high, still over $100 billion in US dollars, but lower than we expected. It was a relatively benign year. So as things go on, as rates continue to go down, if losses stay very high, then we would expect these returns to moderate somewhat. We wouldn't expect to see these really exceptional returns continue. But still, reinsurers have positioned themselves well. And if these conditions continue where a really significant portion of cat losses are coming from these smaller events, and we don't see a lot of new competitive pressure being put on the industry, and reinsurers are able to sort of maintain their high investment income and these sort of really structural de-risking measures that they've taken on their portfolios, then they've positioned themselves to continue to remain profitable and continue to meet and exceed their cost of capital for the near term.
Thank you, Helen.
Thanks, John.
That was AM Best industry analyst Helen Andersen. You can find the full report online at ambest.com. For AM Best TV, I'm John Weber.